My name's Andrew King. I run distribution at Channel Capital. We are Sage Capital's distribution partner and non-investment service provider. Thanks everyone for joining. Just before we start, I'd like to just let everyone know that when we get to Q&A, there are over 120 attendees on this call, a mix of institutional and advisor-led investors on the call. Now, what I can say is that we'll try and cover as many of the Q&A as possible, but what I can tell you is that we'll definitely get back to every single question that's logged in the Q&A portal for anyone that's on the webinar. And I'll just kick things off very briefly. If you look at the presentation in front of you, just a quick flick through. For those of you that are a little less aware of Sage Capital, Sage Capital is a specialist long-short investment manager in Australia that run two strategies, of which the investment process has actually been developed over the last 20 years, led by the CIO, Sean Fenton. The agenda for today will be a quick snapshot of the performance of both of the strategies that the team run. The first strategy is the Sage Capital Absolute Return Fund, and the second strategy is the Sage Capital Equity Plus Fund. We'll touch on how both strategies have performed and look a little under the hood a bit more on the investment process. The investment process that Sage Capital run combines both quant and fundamental. And obviously for some people that's a little bit different than the long-short investing that some of you may be used to. Following that, Sean will give us some insights into how they've managed the portfolio through the recent volatility, as well as comparing this to recent downturns and going back to the GFC, how the portfolio is positioning looking forward, and some insights into how they're looking to manage both portfolios within the context of likely continued volatility ahead of us. Before I do that, I'll just give a little bit of an introduction to Sean Fenton. For those of you who don't know who Sean Fenton is, Sean was one of the first long-short managers in Australia, launching one of the first long-short strategies at AMP in 2000. Following that, he was backed by a couple of very large, high-profile super funds to launch the Tribeca Alpha Plus Fund in 2006. He ran that for the following 13 years, produced top quartile performance through the cycle, including the GFC since inception, and one of the few strategies in the market that had scalable institutional money, and was actually soft closed for a large part of that period whilst he was at Tribeca. The investment process is a direct reflection of Sean's investment process that he's built over the 20 years. He's joined in the team by Kelly Ma with over 20 years of fundamental experience. Kelly is a portfolio manager. Peter Moore, who's joined Sean from Tribeca. Peter got a PhD in applied maths. He's the quant-focused portfolio manager in the team. And James Delaney, with over 12 years experience, also joined Sean from Tribeca. He's a fundamental portfolio manager that focuses on bottom up. We may as well flick forward to the next page on recent performance. Look, I think for the Absolute Return Fund, just as a refresher for those who are less familiar with the strategies, both strategies play particularly different roles in a portfolio. The Absolute Return Fund is a market-neutral long-short strategy. It targets a beta of close to zero and a volatility profile of 8 to 10% per annum, ultimately aiming to achieve returns of cash plus 8 to 10% per annum over the long term, regardless of the direction of equity markets. So they basically strip out any equity beta. And as you can see, it's obviously great to point to positive performance, but I think the most important piece of this is actually what lies beneath that, and that is actually the volatility and beta has been bang on the risk budgets and controls that the team set. True to label since inception, the beta's been negative 0.1. Volatility is right in the middle of the target band of 8.8%. And on an annualised basis, they're got a Sharpe ratio above 2, which is great. If we flick forward to the Equity Plus fund, the Equity Plus fund is an active extension 150-50 fund that effectively targets beta as close to 1 as possible, where it wants to remain fully exposed to the equity markets at all time. It aims to generate alpha of approximately 4 to 5% per annum over the long term, with a tracking error of 4 to 5%. So thankfully, as you can see, in a similar fashion to the Absolute Return Fund, the Equity Plus Fund has successfully achieved its objectives since inception in August last year, with a tracking error of 5%, beta of 0.9, and information ratio at about 1.8. What I would stress to everyone on the call is that both strategies adhere to exactly the same investment process, with the only variation being the net long and short exposures, which are varied to control the market exposure, with the market neutral basically eliminating market exposure with a 0 beta target, and Equity Plus obviously beta 1. With that said, I might flick it over to Sean and kick off the presentation from Sean. But I guess to kick things off, Sean, can you give people a bit of a refresher on the process and explain the benefits of combining quant and fundamental, and how that's played out into the recent pandemic, and effectively a bit of a background on how you came about, building this investment process. It's a reflection of your 20 years in the market.
Yeah, sure. Thanks for the introduction, Andrew. And I'll run through there. So hopefully everyone can see that on slide 6. So as Andrew mentioned, the investment process is quite unique, blends together both quantitative and fundamental analysis. And they're really coming at stock selection from the same angle, trying to find companies that have improving earnings trends and good valuations and are well positioned, but they exploit market inefficiencies and information in different ways. The quantitative process is really designed to exploit behavioural biases, and it does that in a very systematic way by ranking stocks right across the ASX 200 according to a range of different factors, from momentum, value and quality. And because human behaviour is quite static over the long term, we can exploit a lot of those behavioural inefficiencies in terms of how people deal with information and extrapolate it out. And with this systematic process, you're actually able to harvest good returns through time. In the context of the current crisis, though, and some of our lessons, and having managed money with a quantitative process, really since kicked off back at the AMP in the mid-90s, seen quite a few crises there, and the largest of which to date was the GFC, and a lot of volatility around there as well if you consider the Asia crisis, Russian bond crisis, tech blow-up, and other things. And what you do find is during periods of heightened volatility and uncertainty, a quantitative process by itself can break down, and in particular, momentum strategies do very poorly in those periods. We saw that quite starkly through the GFC and frankly through this period as well with the coronavirus crisis. We see those factors break down as well. So one of the lessons learnt through history in terms of our process is being able to actually turn off some of those signals during periods of heightened volatility. And we did that quite proactively through February and March within our process. So we dialed down momentum and really focused on value and quality there, which certainly reduces some of the exposure to whipsawed in the market. But even in normal times, a quantitative process does leave information on the table. And one of the reasons we blend in fundamental analysis is being able to go the next step further, go deeper, and really get some genuine insights into companies and how they manage money, how they drive their profitability, and identify where opportunities are. So we always believe there's an opportunity to add value beyond a quantitative process by having insightful and experienced analysis. We do that consistently. In normal times, we'd blend those together, half the information coming from both. to drive our overall portfolio. And one of the things worth emphasising there on the fundamental side is that we do that in a style neutral fashion. So we don't believe cookie cutter investment propositions of buy a company with low PEs or low price to book value or high return on equity is in itself a long-standing way to make money across market cycles and in different market environments. So our fundamental analysis always emphasises being comprehensive, understanding all aspects of a company and an investment decision. And by being comprehensive, it's also quite flexible. And that means that we're actually able to adapt that analysis to the market environment. And that was another big lesson that we learned through the GFC, and one of the reasons we performed quite well through that period as well. We're actually able to recognise what's happening in the market and adapt our analysis there. So in times of great uncertainty and shocks, we're actually able to step back and look a bit more top down at the economy and what's happening from a macro perspective, rather than look at what really counts in terms of what's driving markets, be it liquidity, volatility, risk, balance sheet strength, near-term earnings risks. So that comprehensive fundamental approach means that we're able to adapt to what's important in markets and analyse companies accordingly. So the two aspects of the process give a very broad and consistent investment approach through time. So I really think of the quant approach as a foundation to our investment approach in terms of getting some good, strong base information there right across the market. A lot of in-depth insights coming from the fundamental side, combining those together to come up with a portfolio of 100, 120 active positions. And in unusual times, there's a flexibility to continue to do that and do that effectively. And one of the most often overlooked but important parts of that overall process is portfolio optimisation and risk control as well. It's one thing to have great ideas about companies, but as we've seen, obviously through the last couple of months, things can happen. The future's always to an extent unknown, but sometimes can be highly random. And if you're not controlling your risk appropriately and leveraging the benefits of diversification, then that can really come a cropper and you can lose all the value of your information. So we've got a very strong emphasis on portfolio construction. I'll touch on that a little bit further down the track as well. That said, on the investment process, just as a refresher background there, might be worthwhile considering how that's played out through the current pandemic. So just reflecting back a little bit on the evolution of this pandemic, global lockdown and what's happened there, it really started to come to our attention through mid and late January, where you started getting reports of new coronavirus around Wuhan, and eventually China moved to lock that down at the end of January. You started to see travel restrictions pop up. So the initial phase of that was recognising the impacts of travel. So immediately thinking back to SARS in 2003 and what companies were impacted there. So obviously airlines, travel-related stocks, some tourism-related stocks. So we're actually at the start of January quite long. Our biggest overweight was corporate travel in the portfolio. We're long some domestic tourism, casino names. We're long Qantas, for example. So the first thing we did was start to cut some of that exposure and put some shorts on to hedge that out in terms of some of similar casinos, Crown, Flight Centre and the like, where we could hedge out that exposure. At that stage, it looked like it might be contained within Wuhan and a pretty short episode like SARS, and we were thinking more about opportunities to buy back into those stocks. But we were keeping a pretty close eye on the evolution of things, and it became quite clear quite quickly that the disease was highly transmissible. Some of the case study evidence coming out of the Diamond Princess and how it was spreading out of quarantine areas in the US and elsewhere. And then when you start to see clusters of deaths start to pop up in Italy and Iran, it became clear that there was broad-based transmission around about the middle of back end of February. And at that stage, we started positioning the portfolio far more defensively. So we're moving overweight supermarkets, overweight healthcare, telecommunications, cutting our exposure more aggressively to consumer discretionary, travel-related stocks. And then as we saw that move on through March, the next phase, which was also reminiscent of the GFC, was a real breakdown in markets and a degree of dysfunctionality coming in there. So we were starting to see liquidity breakdown in markets. So you're seeing equities being sold aggressively. You start to see bonds being actually sold aggressively, credit blowing out, as you saw just broader liquidation events. And what flowed out of there was really some learnings from the GFC as well, which is focused strongly on balance sheets and leverage. So you started to see companies that had any sort of debt, and particularly debt and some top line exposure, really come under pressure. So you saw consumer credit exposed names. So think about things like Afterpay and Credit Corp, sold down aggressively. The banks obviously came under pressure. Infrastructure stocks with leverage and exposure like Transurban and Sydney airports, the whole REIT sector, anything that had leverage was exposed there as well. So that volatility provided some great opportunities to make some money, which we were able to do. Roll on to the next slide. So one of the important things as well through there was, as markets became dysfunctional and broke down, you saw volatility spike aggressively. So the VIX, the S&P 500 measure of volatility, moved from around 10 to 12 to a peak of about 85 in the middle of March. And that's very reminiscent of the GFC and the breakdown in markets and liquidity that we saw there. And another one of our strong learnings from the GFC was to control gross exposure and control risk. So when underlying volatility is exploding, you need to have far smaller positions to actually target the level of volatility that you want. So we needed to adjust the portfolio down. So that was a combination of the market falling, positions falling, but also taking profits and some of our shorts that were doing well, and taking smaller positions in a range of stocks. So you can see in that chart, in the absolute return fund, how the gross exposure came down. So we're still targeting the same level of underlying volatility, but our gross exposure came down from close to 300% down to just over 100%. And you can see, also the number of positions within the fund came down as well. And you can see a similar dynamic occurring across the Equity Plus fund. So there we go. So once again, gross exposure came down from close to 200% down to a little over 100%. So the amount of shorting that we needed to do to actually target our level of volatility is far less. And that's very important in terms of delivering consistent returns and, frankly, just not blowing yourself up during that period of volatility. So that frenzy really peaked out around about the middle of March. And another reflection of some of these episodes in the past is that what we were seeing through the end of March was really a degree of panic selling across markets, and a lot of technical selling as well. So there would have been sort of feedback effects through derivative markets and hedging. We would have seen a whole range of rebalancing and forced selling, people searching for liquidity. So we saw things even like gold was sold down in gold equities during that period. That was also reminiscent of the GFC. And that can lead to a bit of an overshoot in markets as well. So let me just flick forward a slide there. Actually, before I get into that, I'll just touch on one other aspect of risk control, which is not just controlling gross exposure, but as I mentioned before, controlling risk in the portfolio is very important, particularly when you're hit by macro shocks. So we break down very intuitively risk control into three broad areas, which is exposure to the market. So we generally target a beta of 1 for the equity fund and a beta of 0 for the absolute return fund. We targeted slightly less than that, so more like 0.9 during this episode, which is sort of where our risk limits sit there. So being a bit more defensive. The other aspect is controlling sector risks. That's really reflects style and macroeconomic exposure. And the third area being size bias. So in terms of sector risk, we do look at the market in a bit of a different light, where we've done a lot of work grouping the market and clustering different stocks into broad economic sectors that display exposures to macro factors in a similar way and behave in a quite a correlated fashion. So you can see defensives, that'll be things like supermarkets, done very well. Domestic cyclicals like retail and builders, obviously a bit more exposed. Global cyclicals can vary. They can be things like a Flight Centre or a Qantas, or they could be a more shallow cyclical like an Amcor and a Bramble that have held up better. Gold is a very particular asset class, almost a currency that we split out. Growth stocks such as technology, healthcare all fall in there. There's been some real divergence in performance through there based on exposure. So things with consumer credit like Afterpay or Credit Corp have been hit hard, whereas healthcare stocks like CSL or Fish and Pike have done exceptionally well. REITs makes sense. It's clearly a separate asset classes. Resources ex gold, obviously driven by commodity prices, global growth, industrial production, and the like. And yield stocks includes banks, insurance, some of the infrastructure, and that's leveraged to the yield curve. Tends to be more defensive, but you can also get divergence there, obviously with balance sheet and leverage during times of stress. So controlling the overall portfolio exposure to those different sectors is very important in terms of managing exposure to shocks and controlling risk. So we keep a close eye on those, manage them pretty tightly. We'll tilt around the edges, so obviously defensively tilted through the first part of this episode, where we're overweight defensives and gold and some of the more defensive yield stocks, underweight resources and pretty neutral on growth stocks. And the last part, obviously, is size as well. So during these periods of panic, liquidity is king. So you will generally see small caps hit harder. They tend to be a little bit more sensitive, more volatile, but just liquidity pressures can hurt them as well. And we certainly saw this through the current sell down. So we also had a focus on size and liquidity through the portfolio. But just as that's where we want to focus on the portfolio on the way up. Sorry, skipped on one too far there. Things also got a little bit beaten up and oversold. So as I said, there's a lot of technical selling occurring through the market, a lot of forced selling, and it's always hard to work out where the bottom is, but that was clearly in the sort of middle second part of March. And as that forced selling abates, and a lot of this was probably triggered by central banks, US Federal Reserve, stepping in and declaring they'll do whatever it takes, and literally doing that in terms of expanding holder facilities from corporate debt markets, cutting rates very aggressively, and providing liquidity to the system. So the lesson that central banks learnt from the GFC was make sure that the short-term funding markets and liquidity is there and plentiful. And by doing that, they put a little bit of a buffer into markets and a bit of a pressure valve. So the panic selling abated, and we've seen a reasonably solid rebound. I'll touch more on the sustainability of that rebound later, but certainly that was an opportunity for us to lock in profits on some of our shorts and look for companies that had been a little bit beaten up. So central bank intervention, obviously a lot of fiscal support from governments as well, announcing some very massive packages, has helped to take some of the downside in terms of plunging into deep depression risk out of the economy and the markets. So where we go back to looking for opportunities there, The Fed providing liquidity means that balance sheets are a little bit safer, and then companies doing capital raisings as well. So that provides opportunities for companies to de-risk. And a lot of stocks have been re-rated quite well following capital raising, so that can often be an opportunity to buy into stocks there. So we've been taking on a little bit more balance sheet risk in oversold stocks. So we went from being short to being long Challenger. Closed our shorts on Afterpay, went from being short to a little bit long in Flight Centre, moved back into some of the casino stocks and the like, as well as taking profits on some things that have done very well, like Telecommunications, some of the healthcare stocks, some of the supermarkets. So that enabled us to keep that performance going through the second part of March and into April as well. So that's really a reflection of what's happened to date, but maybe just looking a little bit further in terms of what's happening going forward. Let me just roll forward another slide. So where we sit at the moment looking forward, I've got to say, having lived through and managed money through the GFC, that was a period of great uncertainty. Was the financial system going to collapse? We were going to see a complete breakdown in banking. The good news out of this crisis is I think central banks have solved that problem. We're not necessarily going to see a financial crisis, but don't think any of us have ever seen a shock to the real economy of this scale and magnitude. So the high frequency data out there in terms of business surveys, said in the US from manufacturing, it's particularly showing up in services industries and surveys, obviously with leisure, hotels, restaurants all shutting down, tourism shutting down. That's hitting the services industry very hard. You're seeing it in high frequency data in terms of US initial jobless claims, seek new job ads falling very aggressively. So a massive shock, and that brings a lot of risk with it. And to counter that risk, you've had massive fiscal and monetary stimulus, as I said. And at the moment, we really are in a gigantic economic experiment where there's going to be a huge tug of war between the impacts of the shutdown and the cascading second order impacts of that through the economy, and the efforts by authorities to offset that both monetarily and fiscally with stimulus. And the last sort of piece of the puzzle there is really what are the long-lasting impacts, changes to behaviour that might resonate through the economy and markets to come. So maybe looking a little bit further ahead, just on, sorry, go back one. I think Andy and I are controlling this presentation at the same time, so we're jumping around a bit. But in terms of the outlook, there are a huge number of risks there, and I've put 6 of them on this chart, but I could, the list goes along further than, a lot further than my arm. So just thinking about it quite quickly, it's going to be very difficult to just seamlessly rebound from this shock. So there's certainly going to be a lot of pent-up demand. We are going to see a V-shaped recovery when travel restriction, just travel restrictions, but the lockdown ends and people want to get back to work and spending again, and you'll see that. But not all of it will come straight back. So travel and tourism, they'll be quite slow to rebound. So the jobs won't be there. There'll certainly be some permanent job loss coming out of this. And what makes it very difficult is trying to work out the second order effects of that. So does that feed through? You've got a lot of forbearance going on in the banking system at the moment, so there's potentially bad debts accruing there. Businesses may start up again, but households might be more conservative. They certainly might be looking to build up savings, which can weigh on aggregate demand. So a lot of businesses might start up again and then start to fail. That can feed through into back into the banking system and bad debts, and that can impact on banks and their willingness to lend, which can feed through to investment and consumption. Consumer credit books come under pressure. So it's certainly very easy to paint a picture of negative second round effects feeding into the economy. And I think the risks of a W-shaped recovery of a sharp rebound and then business failure and job losses and slowdown is very real. The other clear risk, I think, is just a second wave of the virus coming around, the fact that we can't actually ease up as quickly. And there's certainly a lot of precedents for that. The Spanish flu saw several waves, and that was before air travel was mainstream. We do know that it spreads quite easily in the community. So we're keeping a close eye on China and elsewhere to see whether reinfections pick up again as the lockdowns are eased. So we might be in a situation of partial lockdowns which come and go and can also restrict business activity and confidence. So there's certainly a lot of reasons to be cautious on the market and the outlook. And as I mentioned, there's a lot of high frequency data out there that is as bad as it's ever been. This chart just shows the National Australia Bank business confidence indicator. You can throw up the Westpac consumer confidence indicator. The US National Association of Home Builders, it's fallen through the floor. So these are levels that are just signalling a massive economic calamity coming down the track. The good news is that a lot of that is due to the government lockdown and enforced lockdown. So it hasn't crept in through breakdown in the usual path of excess leverage and overinvestment, then driving bankruptcies and employment layoffs and everything else. But that said, it is still a very meaningful impact. On the more positive side, as I said, central banks are doing whatever it takes. So rates near zero, they're buying bonds, so yield curves are flat. Importantly, they're out there trying to directly support lending to small business and corporates. So the US Fed Reserve's got a facility there buying investment grade paper, and they've expanded that into sort of junk grade as well. That's doing wonders in terms of getting credit spreads back down again. And obviously government's winding up stimulus. So we will see government debt blow out all around the world. You've seen a lot of talk around modern money theory and what that means, the ability to do that. That's another whole presentation discourse in terms of what modern money theory means, but it's fair to say the genie's out of the bottle in terms of central banks monetising government debt, and you're seeing it obviously here in Australia as well with the RBA embarking on yield curve control. So they've flattened the yield curve 25 basis points out to 3 years, and it's pretty flat out to 5 before ticking up a little bit. The government's out there spending a lot of money, and they'll spend a lot more money before this is all over. So our national debt will be soaring up. But the Reserve Bank's essentially ensuring that the government can continue to finance that deficit spending and do it at a very attractive interest rate as well by expanding their balance sheet and purchasing that. So we are in debt monetisation, and that in itself adds to the uncertainty of the outlook and the future paths that we can take. Certainly through history, examples of debt monetisation causing massive hyperinflation, notably Germany after World War One, which paid off all their war bills by printing Deutschmark, led to the Weimar Republic and the rise of Nazi Germany. Zimbabwe pops up, obviously, as another example there. There's also examples of that occurring, in essence, in Japan with large-scale stagnation and deflation. So as long as the productive as long as people aren't trying to spend the money that's being printed beyond the productive capacity of the economy, you're probably not going to get inflation. And that's been our experience with QE in the last decade, is that QE and central bank asset purchases has driven asset prices to higher levels, but people haven't tried to spend that because the yields have been falling. People have been accruing assets and hanging on to them. So it's been really an accounting exercise of driving up asset prices, driving down return on investment, and making leverage problems essentially go away, but not doing a lot in terms of stimulating spending or driving inflation through the economy. So that's probably what's going to happen going forward, but these are unprecedented times, so hyperinflation's on the table as a possibility out there as well. So I've sort of waffled on a bit there and got away from the positives, but the other, I think, enormous positive is the adaptability of human beings and the ability to overcome challenges and move forward. So I have no doubt we'll get the world economy back to where it was at the start of the year. The question is just the roadmap to get there and the path that we go through. But even with a seasonal virus that wanders around and kills vulnerable people every year, people will eventually just still get on with it. The economy will move forward and people will adapt. So that's probably the most important long-term positive. But what I really want to emphasise out of that's a list of positives and negatives, is I can paint a picture for you anywhere from we're entering something worse than the Great Depression that'll be with us for a decade and change life as we know it, to we come roaring back. It's a pretty short-term impact, and the market finishes the year higher than where it is today. And the outcome is truly unknown because this economic experiment hasn't been conducted before, and people are really just guessing. So in this environment, what's really important is to be balanced and flexible. So not committing to a view of the future and sticking to it. Being aware of the possibilities that are out there is what's important, and being able to react quickly to developments and new information as it emerges is also important. So that flexibility in terms of investment process, but in terms of thinking about the world and the ability to change your mind as well is very important in this environment. So that's what we're really looking for and focusing on in terms of our outlook, recognising that our outlook is really that the future is the most uncertain that it's possibly ever been, and to manage the portfolio in line with that as we go forward. So I think just...
Sean, I might kick off a little bit of Q&A, and from here, conscious of time with 20 minutes remaining. But just quickly, one question that's come up before we get into a couple of investment themes. I guess one of the questions is kind of what returns are you seeing generated from shorting? And also, given that we're going to touch on a few themes, can you just, within the context of the investment process, touch on a couple of themes that then maybe remind, a typical question that investors ask is, what's your top position? What are your top exposures or your highest conviction ideas? And then what are your highest underweights and so forth? Can you maybe reflect on that a little bit? Because I guess I'm conscious of us talking about a couple of themes and longs and shorts within the context that it's quite a diverse portfolio.
Yeah, sure. So just in terms of returns generated from shorting, it's important just to think about it firstly in two ways. So it's we tend to think about long and short in terms of returns generated. Has it outperformed the index or underperformed the index? But obviously in an absolute return sense, and like the absolute return fund, in this environment, our longs and our shorts are balanced. When the market falls 20 or 30%, all the returns come from shorting, and you lose money on the long side. And and the objective is just to make more money on the short side than the long side. So recently, the very straight answer is all the returns, with the exception of a couple of stocks that have gone up, like Fisher and Paykel and Coles or Woolworths or something, the bulk of the majority of returns have come from shorting. But if you think about it more in terms of the market's fallen 20%, some stocks have fallen 30, some 10, then we expect more of an even contribution from our longs and shorts from what's under and outperform the market. And if you take out the extreme movements the last couple of months and look over, say, 10 or 20 years and what the fund delivers, it's a reasonably balanced return between the long and the short side. But obviously in an absolute return sense, when the market falls a lot, the shorting's what's really driving returns there. Maybe just sort of moving on to a couple of the investment themes up on the chart there. As I was talking about before, having risk control, diversification and flexibility is very important across the portfolio. So I'll just put in a couple of investment themes that are worth highlighting. And it just gives an example of how we control risk and how we think about market inefficiency. So the first one's just resources. The consensus at the moment is to be long bulk resources, long iron ore. There's supply issues there in terms of Brazil. China's going to stimulate. Steel demand's held up very well. Iron ore price is very solid. Great cash flow yield. We wouldn't disagree with any of that per se. We do see some risks of China seeing feedback effects from emerging markets slowing down and potentially steel demand in the rest of the world dropping and dragging down the iron ore price. So there's a risk there and not quite priced for that. But on the other side, a lot of the people providing services to mining stocks such as Seven Group or NRW in terms of mining services, moving dirt, servicing big yellow trucks and the like, their share prices have been completely torpedoed. They might have a little bit of gearing, but if their top line's solid and being met by demand for bulk commodities, then there's no reason they should be hit by that. So being short the bulk commodities there and being long the mining services is playing that breakdown that we've seen in, rationality across the market, which is driven by that panic selling, excess focus on balance sheets and liquidity. So that sort of trade doesn't expose us too much to the world. What's going to happen if iron ore rolls over? They'll all fall, but the actual commodity producers are far more leveraged in that position. If things are pretty good, then there's going to be a recovery trade through the mining services. And we've started to see that play out in the last couple of weeks. Another example of that is across the healthcare space. So, we like healthcare, but we don't want to have the entire portfolio in healthcare because, as the market bounced the last couple of weeks, you would have done your shirt. So we're looking for those opportunities again. So one of our favourite stocks through this environment has been Fisher and Paykel Healthcare. They directly benefit from coronavirus breakout in terms of they sell humidification equipment for ventilation into the hospital setting, as well as doing oxygen therapy and non-invasive ventilation. So they're seeing demand really pick up materially. And as we move forward from this, our expectation is that pandemic preparedness and focus and their ability to actually get more penetration to hospitals will help their business long term as well. So we see this as accelerating their growth rate more in a structural sense in the medium term. It's not cheap, but nor should it be. We quite like it. On the other side of the coin, Ramsay Healthcare, hospital, very safe generally, but doing private elective surgery. So that's all actually been shut down. They've got exposure across France and UK and Australia. So that impacts them. They've got a fair degree of leverage there and operating leverage as well, reasonably high fixed costs. So that's a bit of an impact there. Elective surgery will eventually come back. Ramsay will recover. But it's not really priced for those short-term impacts and any risks around there. And if you get further outbreaks and a second wave and the like, then you could see longer-term shutdowns of elective surgery. So that's another way of doing that. And just the third point I think it's probably worth touching on as an investment theme. I mentioned before that central banks are doing whatever it takes, and this chart just shows the US Federal Reserve's balance sheet and how it's responded to the crisis. And it's fair to say, money printing is back. And in this environment of extreme government intervention, it's happening all around the world. Everyone's devaluing their currencies, which they can't do. We often think of gold as the currency, and in this environment, it's an area that we quite like. It also provides great diversification across the portfolio in terms of volatility and risk off. So it's an area we've got exposure. We like some of the domestic producers there, Saracen, Evolution. We've got good low-cost structures and some solid production growth. At the moment, the Aussie dollar spot gold price is through the roof, and they're all printing money. So we quite like that, even as we go into recovery mode. So gold's been a bit volatile in the last couple of months. We saw that in the GFC as well. You get some liquidity pressures come in there and liquidation events. But as volatility comes down and that money printing continues to roll on, we expect gold to do pretty well. So as Andy mentioned, that's not to say these are the only positions in our portfolio. It's worth mentioning that we do run over 100 active positions. So we've got dozens of these different thematics running through the portfolio. Sometimes they're more a set of stocks. Sometimes they can just be individual stock ideas. And risk is managed really holistically, pulling all those together, looking at all those exposures. So the key there is to not rely particularly on one state of the world or one particular stock outcome, but really have that diversification and the flexibility in the investment process that Quant the Fundamental enables us to maintain that wide range of investment ideas across the portfolio. I might hand back that to Andy for Q&A.
Sure. Thanks, Sean. I guess there's a couple of key questions with regards to the quant and fundamental allocations in the portfolio and how you risk weight the balance of the two. We've got a question to say, did that allocation change in March of this year? And then how has that changed through time? Obviously, you mentioned you switched off the momentum, but in terms of that risk-weighted balance of the two, has that changed significantly? And likewise, has turnover, how's that compared as well during this period?
Yeah, so as I mentioned earlier on, quant is a really powerful part of our process, but this isn't the environment in which quant does really well. So we are emphasising the fundamental side a little bit more. There's still quants feeding through and providing some base valuation measures across the portfolio, but the flexibility of the process there, the ability to emphasise the fundamental side where you've got such a rapidly changing environment. Consensus earnings are still reacting to what's happened and trying to catch up there. So what we saw in the GFC was that sort of scenario. The shock hit and you got then a bit of a snapback. Once the volatility came down, things started to settle down. Whatever state of the world we come into, the quant was about delivering better. We'll turn the momentum factors back on. We're slowly doing that now, and we'll drive a bit more exposure through the quant side. In terms of turnover, we've been a lot more active, actually rebalancing the portfolio and moving around. Obviously, the market volatility lends itself to that. But the fact that the gross exposures come down because volatility is so high means that actually turnover hasn't changed that much. So the two things offset each other. We've been more active changing positions in single names and moving those around, but our trade size has fallen, our exposure size has fallen as we control risk through that period of heightened volatility.
Great. Another question is, are you overweight financials, and hence what is the prospect of banks going into a recession with ultra low rates and a flat yield curve?
Good question. So we are pretty neutral. We're a little bit overweight financials, but it's quite a diverse group of stocks actually at the moment. that are moving in different directions. So within financials, we're overweight insurers. So we have some IG, QBE, which are reasonably more defensive. They've got some investment exposure there, but both of them are pretty low equity exposure, short tail risk, and largely cash fixed interest sort of investment portfolios. Insurance coverage should be okay. I think IG we actually quite like. In fact, motor claims with road traffic being down so much could be quite a big benefit. We've certainly seen the road toll fall over the Easter long weekend. We have some infrastructure stocks there like electricity, retails, distribution that are quite defensive. On the other side, we're short Transurban and Sydney airports, where there's a very direct hit to their business from obviously international tourist arrivals, migration that's not going to come back in a hurry, and obviously road usage as well. We're actually underweight the banks. We do see some material risks there, not just the impact. You've already seen the impact of rate cuts. Flattening the yield curve is going to pressure net interest margins there. But it's really the risks around bad debts and how that pans through. And I mentioned before that we see risk building up in the banking system, and that some of those risks are becoming quite binary. So at the moment, there's a lot of forbearance. There's central bank liquidity facilities there trying to keep things going. And if we get a good recovery and a good rebound and things get back to normal pretty quickly, then a lot of those things that are in hardship and forbearance will cure themselves and will roll along. And frankly, the banks then look really cheap, and you want to be involved on the long side, even with net interest margin compression. The downside there, which is quite asymmetric and very long-tailed, is that we don't get a good recovery. Some of those forbearances actually start to go bad, and that feeds back onto itself. So there's some very material risks there. I think one that is only just being focused on now is the impact to Australia of migration. We'll probably see our population shrink. About half of our annual migration comes from students, which have all gone away and have left and gone out. And that drives a lot of things like housing demand. We've still got a huge amount of housing completion finishing from the previous housing boom. You're seeing holiday lets, Airbnb coming back onto the market and the like. So that can feed through into the economy in terms of construction and jobs there. Obviously, our exposure through the education sector, and tourism as well. So it's quite likely that international travel is going to be locked down the longest, and that's quite a weak point of exposure to the Australian economy. The other obvious risk is China. As I said, if the world has a deeper recession and China is impacted and iron ore prices roll over, at terms of trade are vulnerable there as well. So a period where the banks are giving forbearance, allowing bad loans to build up, you're having an economic shock, that could turn out quite poorly. So we want to be underweight banks just on that risk, but we'll keep a very close eye on it because, as I said earlier on, everything is on the table in terms of where things pan out.
Thanks, Sean. I've got a couple more questions still coming through, and everyone feel free to keep them coming. Another question we've got is, in general, market neutral equity strategies have been, somewhat disappointing for some investors in Australia historically across the peer group. And for everyone on the call, we'll happily provide. There's some peer analysis and since inception of the strategy across both the equity plus and the market neutral. But why does incorporating, I guess, both quant and fundamental inputs into your investment process tend to generate a lower volatility of returns and maybe a fundamental only or quant only investment process? I guess, can you give us some more colour on why market neutral might make sense for a lot of people that may have exposures to previously to market neutral? Because what we do see a lot of in Australia are effectively market neutral in inverted commas strategies, but effectively if you look at their average beta since inception, it's like 0.2, 0.3, and so they're actually not pure market neutral. Do you want to just touch on how your process fits within that for those that are somewhat a little bit less confident or had a less than ideal experience in market neutral?
Yeah, it's a good question. It's fair to say if you look at the peer group of market neutral absolute return strategies, they're far less homogenous than, say, equity strategies or something similar, because there are a lot of different ways to structure those funds. And you mentioned a few of them. Quite a few of them, whilst being absolute return, might not be market neutral. So they might just be simply focused on delivering good returns, but taking quite a lot of exposure to the market, maybe in a very concentrated sort of fashion. So that's obviously going to drive a lot more volatility in returns with market cycles. And there'll be some that vary around and try and target the market. So depending on successes there, can be better or worse. So actually finding the right peer set to analyse is difficult, and there's a lot of different strategies. So I think it is worthwhile understanding what a particular absolute return on market neutral strategy is trying to achieve. And what we quite clearly do is we try and beat the cash rate and do it without taking huge tilts at the equity market. So we run our cash and our beta very close to zero in the absolute return fund. And really focus on adding value through a whole range of long and short exposure across individual equities. And that's probably the other point as well. Being absolute return doesn't necessarily mean well diversified. So one of the great things about a long-short structure means that you can target whatever level of return and risks that you want by the gross exposure you run, the size of your longs and shorts. You don't need to concentrate that down. So it gives you the opportunity to run a very diversified portfolio, which can deliver, which will deliver more consistent returns through time. It's pretty much a mathematical truism that the more diversified your portfolio, the higher information ratio, more consistent returns you're going to deliver through time. So we look to really exploit that by having a very well-diversified portfolio, and that's supported by our investment process, in particular having the quant process there that gives ranking right across the market, a lot of breadth, enables us to run very diversified portfolios. So, for someone who's looking to get returns that can beat cash but don't want to take on equity market exposure and this volatility, then the absolute return fund's probably something that fits the bill there.
Great. And then I guess, onto the active extension, there's been an increasing investors, in Australia opting for kind of low-cost passive funds in Aussie equities in the long-only space. Can you explain how the active extension approach makes sense versus, generating our performance after fees versus, effectively a low-cost option or the like, and how that, philosophy speaks to, your beta one approach? Obviously, we've explained the market neutral, how that fits into the portfolio for those wanting to strip out equity exposure. 150/50 active extension, can you just kind of touch on that, if that's okay?
Yeah, sure. So the 150/50 fund is an equity fund. So as opposed to cash benchmark, it is managed against the equity market and has exposure there. So through time, that'll give the benefit of growth there. You can get that growth cheaply through a passive fund or an ETF. So our objective is clearly to add value beyond there and beyond the index. So just as our investment process is focused on delivering value in the absolute return fund above cash as benchmark, we'll deliver where through our investment process returns above a passive or the equity index. So that's what we're really offering, and through time that can compound quite materially. So obviously the funds have done very well since we've launched and through March. A different experience in an absolute sense between the absolute return fund and the equity plus fund. The equity plus fund's obviously dragged down by the market. It's outperformed it quite well. But that's something that's really then compounds on itself. So preserving capital through that period. As you go into recovery, that grows and compounds on itself. And the active returns, being able to deliver that, that drives returns far in excess of what a passive strategy can deliver over the long term.